folks, Sean Broderick here for Weiss Ratings. Today we're going to talk about one of the big arguments going on in the market, the argument between growth and value. Because many people say, well, you should be buying growth stocks, many people say you should be buying value stocks. Let's start by looking at seeing who's winning right now. We'll use that doing a relative rotation graph. This is something you can find on StarkCharts.com. I'm a subscriber there. I don't get any money from this, but I believe that non-subscribers can look at it, and I will include a link in my comments on this video. So I'll call up a relative rotation graph that just shows what's going on between growth and value. Now, you can put anything on a relative rotation graph. You can put in different industry groups, you can put in ETFs. Basically, it's like you can see where money's flowing into and out of it. Divides the market into four quadrants: improving, leading, weakening, and lagging. And looking at the relative rotation graph, just divided between growth and value, you can see that growth is definitely leading and value is definitely lagging. Now, why is this? Well, let's look at what's going on inside those big groups right now. In growth, well, you have Apple, Microsoft, Amazon, Facebook, Alphabet, Visa, MasterCard. Those are the stocks that do very well when the economy grows. If you think that the easing of the trade dispute between China and the U.S. is a sign of more good things to come and things will roar higher from here, then definitely you can see why people want to be in growth. Now, let's look at what's in value. Okay, so we have Berkshire Hathaway, ExxonMobil, Bank of America, AT&T, which Wealth Megatrends took profits on not too long ago because it was underperforming, United Health Group, Verizon Communications, JP Morgan. These are all the value plays. Many of them pay hefty dividends. And so you can see that, yeah, sure, if those are more conservative stocks that really, growth in the economy isn't going to affect them a lot. It might affect ExxonMobil and Chevron, but then again, they might be more affected by, say, trouble in the Middle East, which would send oil prices higher. That's what they really function on, higher oil prices. So you can see why these stocks are lagging right now. That just makes good sense. But what happens going forward? Well, I want to show you one more thing, which is the Fear and Greed Index, okay? And so this is currently at 93. What this is a measure of investor sentiment. And so this shows how people feel about the markets. And right now, investors are extraordinarily bullish. That's good, except when you get to the point where everyone who wants to buy has bought and there's no one left to buy. Then things tend to go south. When the market gets overinflated, it becomes easier for a correction, potentially a sharp correction. So, considering how long a run that the growth stocks have had and how beaten down the value stocks have had, you might want to switch some of your money into there just on the off chance that there's a correction. Now, if you believe that the trade agreements between the U.S. and China, which as I make this video, they're still in the works, but are in the works, if you think that's just opened the path to much more growth, ripping the lid off the market, then you definitely want to be there. And you definitely want to be in growth. If you believe that we're set up for some kind of a correction, then you want to start switching some of your money to value. That's just something to keep in mind going forward as you look at the market. This is Sean Broderick for Weiss Ratings. Have a great day.